Hello, everyone. I'm happy to see you. So today I'll tell you about how to define business financial strategy for 2025. Oh, okay. Let's start. Uh, One more time, I'm really happy to see so many people here. So basically, the beginning of each year is the best time to revise your journey for your company, to revise basically your uh, kind of life journey, and basically a lot of companies they start making new strategy for the following years, for the following life cycle. And I really hope that today we can provide some tips and tricks how to plan your finance, how to set up your financial goals for 2025, how to make this year profitable for your company and effective for your company, how to make your business grow during this year. So we'll try to provide useful information to help you to grow your business. So basically, the whole webinar would be about the planning of the future because the year only started. So, and we need to plan until the end of this year. But, it is kind of hard to predict future without past and without present. So that's why, first of all, we will understand how to analyze your historical information if this information exists, because I know that there are some participants who has only startup and they probably don't have any past information, but still for existing businesses, this historical information is a key point to plan your forecast. Then we need to understand where we are right now, and then we can plan future. And after we will have clear picture of the future of the goals which we can achieve during 2025, we need to understand how we can do it, how we can do it faster, and how we can do it in the most effective way. Yep, I see that our moderator writes that chat is working. So please ask any question during webinar. In the end of it, we will try to answer on all of them. Because yes, as you can see, we'll have Q&A session and small kind of incentive for all of you. We'll have special offer in the end of this webinar. So that's why I really ask you to stay until the end. Okay, just to add some credits to my words, I will tell you about myself and John Galt. John Galt Finance is the company who organized this webinar, and lucky for me, I'm a founder and CEO in this company. And what we are doing, basically, we provide CFO on demand, kind of a financial director on outsource, but honestly saying, we provide whole finance department on outsource. So how we are working, we go to company, we check all the data that the company has. If company doesn't have any data, we help them to build the process, how to start tracking the data. Then we are making the basic financial analysis, all the finance reporting, not in terms of bookkeeping, but in terms of finance management. So our main point is to show to the owner what is the finance health of the company, how company can grow, what is the possible risk that company can face. And after we have kind of all the finance plan and we understand the current situation, we help to the founder understand the future of the company. We help with financial planning and analysis. We are trying to assess new initiative, etc. And as kind of at top of this pyramid, we are helping with strategic finance. So first of all, we help to achieve your target faster and in the most effective way. Secondly, if, for example, you have some initiative like exit of the business, or otherwise you want to acquire new business, or you want to try your business in a new region, or you want to fundraise, so we can help you on each of those steps. Some words about myself. My name is Nikolajs. I'm founder of John Galt, and I have more than 10 years experience in financial sector. I have worked in big corporates. I have tried to build my own startups in fintech sphere, in retail sphere. So basically, during the last, I believe, 12 years, I have tried myself almost in each position in this finance journey career. So that's why I really hope that I can share my experience and it could be useful for you. Okay, speaking about finance planning, finance analyzing, and planning the future and setting the goals. As I have already said, the first step should be understanding where you're right now, understanding your past, your historical background of your business, because uh, it helps to be honest with yourself. If you can see that your business was growing 10% per year, it is too optimistic to plan you to grow 100% per year. So usually we need to have a benchmark of the historical value. And also when we have clear picture, we can see which aspect of our business we need to change, we need to improve. So in order to understand kind of your historical data for your business, there are some main statements I believe that each accountant, each business owner, they need to have. It is a kind of a minimum that you need to have for your business, even if it is startup, even if it is small business, still you need to see on your business from the perspective of those three statements: P&L, balance sheet, and cash flow. Further, I will kind of we'll have some more information about each of those statements. And also we need to kind of check the basic metrics. So basically there are more than 100 metrics for your business, starting from capital structure metrics and finishing with unit economy metrics. And of course, when you will be large enough, each metric will add value to you. Some of metrics are crucial and will add huge value. Some of metrics are less crucial, but still you can use it for your decisions. But we are not speaking about ideal world. Let's speak about the minimum. So there are some metrics that you need to track on a weekly basis for any type of business. Even if you are tiny, you need to understand your health based on those metrics. So regarding the statements, the first statement is P&L, profit and loss, and P&L, basically it shows your business health, and it shows can you scale your business or not. I am sure that most of you understand how P&L works. Just a few words about the statements. So the top of P&L is revenue, so all your sales, all your turnover. The COGS is cost of goods sold. It means how much should you spend to sell one unit. For example, if you sell coffee, your COGS is cost of cup, cost of beans, and basic cost of sugar or something like that. So, for example, barista salary is not COGS, it is OPEX, because you will pay the same amount to barista, he will make 1 cup of coffee or 100 cup of coffee. So that's why it is not COGS. So when you have COGS, you can see gross profit. Gross profit, it is kind of the difference between revenue and COGS. And it is this metric, looking at gross profit, you will decide either you need to scale business or not, because you can be you can have negative EBITDA, you can lose money each month, but if your gross profit is positive, it makes sense to scale business. Because let's have the same example with coffee shop. For example, the cost of cup, the cost of beans, the cost of water is 50 cents, and you can sell 1 cup for €4. It means that you will earn €3.5 for each cup of coffee. And if you will sell only 10 of them, it will make you €35. It is not enough to cover the rental costs, to cover the salaries. But if you will sell, I don't know, 1,000 cups, you will have enough money to have the rent and salary, because the rent and salary will not grow. So at the beginning, you will have negative EBITDA, but it still makes sense to scale this business. So that's why basically looking on the P&L, you are deciding either to scale the business or not. And usually P&L is better than reality, because in P&L, for example, we see the revenue basic on our issued invoices. Even if the company doesn't pay, we can see this number in P&L. In P&L, we don't see any, I don't know, debt repayment or something like that. So usually P&L, it's just help you to understand should you scale your business model, but it is not about the health of your business. If you want to understand how healthy your business is, you need to look at cash flow. Because in cash flow, you have not so much about the profit, about your business metrics, but you have about the cash. Because cash is the king. And in the end of the day, you can have profitable model and scalable model, but you need to have a cash to pay salaries, to pay rental fee, to pay taxes, etc., to pay debts. So that's why, uh, and company go bankrupt not because of bad P&L. Company go bankrupt because of bad cash flow. I want to say about one good case that we had in John Galt a few years ago. There was one fintech company. I will not call its name because the management of this company had a mistake, and I don't want to share it with you. But basically, what was the mistake? The management have received on a monthly basis report from the accountant, and they have seen that they had really good situation in terms of P&L. The revenue is growing, the cost mostly the same. So basically, they decided to increase the team because they have seen that the revenue is growing and everything is okay in terms of P&L, and projected EBITDA is very good. In reality, many of their clients, they didn't pay. So they have received invoice, but they didn't pay. And in P&L, you will see it as a revenue, but in reality, you didn't see the money. So that's why in reality, they have received less cash than they think that they can receive. So, and when they came to me, basically their request was as following. They asked why we are increasing revenue, but each month it is harder and harder to pay salaries. And when we have found that, okay, they have a lot of bad debts, we kind of fastly changed their strategy, and basically they was 1 month from bankruptcy. So we saved the company. And this is kind of great lesson for each business, because especially small business, because we need to consider our cash flow, because we also need to understand the health of company, and the health of company is based on the cash flow of the company. And the last statement, it is kind of not so important for many companies, especially on the initial stage. But for some type of business, it is crucial. It is balance sheet. So in the balance sheet, we have asset and liabilities. So we have all our previous investments, we have all our previous debts, and all the equipment that we have. And it is, for example, crucial for retail chain, because in the retail chain, it is hard to predict the cash flow because it depends on the inventory that you have. And you need to always track your balance sheet to understand, okay, how much inventory do I have? Because based on it, I will plan my cash flow, and I will plan how much money do I need. So maybe for some startups, they don't usually build the balance sheet. But for example, if your business relates to some cash conversion cycle, so-called, it means that you buy something, hold, and then sell. So it is crucial to have a balance sheet as well, because in this case, you can predict your future expenses in a better way, and you can avoid situation when you will need to refill your stock and you don't have any free money, and you need to have a debt or something like that. So, but usually balance sheets that doesn't relate to reality extremely. So, because you can go to Lursoft, for example, if you are researching Latvian company, and you can see a lot of companies who are good in terms of balance sheet, but in the reality, the company are poor. For example, if you have a lot of equipment, from the balance sheet, you would be great, because here, when asset, you will have tens of millions. But in reality, this equipment, those assets, doesn't make any money for you, but it require money from you, because you need to repair it, you need to maintain it, etc. So that's why balance sheet sometimes is not the same as business health. Okay, so basically, maybe now you have some questions regarding how to analyze your past historical data and past of your company, so we can make a small pause and go further. You can write this question to chat, and I will answer on it after we will finish the main part of the presentation. Okay. Yep. To understand where we are now, we need to use some metrics. We need to make some accountings to see what is the health of business today. So I mean, I don't know what is the main metric, because usually people ask, what is the main metric for the business? For each business, it is individually. So, and on each stage of the business, it is individually. So, but there are some basic metrics on which you need to take a look, because those metrics can help you to make first decision in a better way. The first metric is net profit margin. So basically, it shows your net profit as share of revenue. So if it is positive, if it is more than zero, it means that you are profitable. It means that your EBITDA is positive, and basic net profit is positive, and you earn more than you spend. And it is not the right answer what should be this margin. It should increase on the one hand, yes, but usually when the company scale, as the practice show, it decreases. So, and if, for example, I can say two examples of the real world. First of all, is, for example, Uber. The company had a negative net profit margin. They had it for 20, I mean, I don't know how old is Uber, but I believe around 15 years. And all the time, the net profit margin is negative. But they still has huge valuation, more than, I believe, 100 billion. And then can scale, because net profit margin is something that you can fix really fast. You can fire half of your employees and your net profit margin can be positive. But when you fix your net profit margin, usually you decrease your growth pace. So that's why many of companies, they kind of don't focus on the growth rate. Otherwise, they focus on the growth rate, and that's why they don't focus on the net profit margin. But gross profit margin should be more than zero always. Another case, for example, Rimi, a retail chain, this Latvian retail chain, and I mean, this is extremely huge chain. I believe they have covered around 40% of the whole market share in Latvia, and they had kind of billions of revenue, and their net profit margin is around 1%. But it is possible only when you have huge team of finance analysts, of data scientists, of data analysts, because when you have 1% net profit margin, it means that a small change can make your business negative. So that's why. But when you grow, when you are huge, 1% net profit margin is enough to pay dividends to satisfy all the shareholders. But when you're small, of course, and you kind of want to use this business to pay dividends, so net profit margin should be quite high, because 1% or from the 10,000 is only 100. So the second kind of important metric is revenue growth rate. Basically, when you want to plan your future, you need to understand your growth space. And there you need to understand that when you're small, it is easy to grow. So when you're small, you can grow with 100% month over month even growth rate. Because, for example, let's imagine we have a company and I don't know, any mobile app, and I have 5 users. Next month, I will have 10 users. I have attracted only 5 users, but the growth rate is 100%. But if I have 1,000 users to reach the same growth rate, I need to attract 1,000 users, and find new 1,000 users is much, much higher than find new 5 users. So that's why you need to understand that it is easier to grow while you're small. And usually when I've seen some forecasts, the biggest mistake and the most common mistake is that founders, for example, the growth rate for 2024 was 5% most or most, and they plan that in 2025 it will be 10%. And they didn't change any marketing strategy, they didn't change any sales strategy, they didn't change any product. They just hope that the growth rate will grow. No, usually the growth rate is decreasing. So, and if you don't change any strategy in your business processes, the growth rate will probably decrease. Because first of all, uh, when you kind of big, the free market is smaller. So you need to find more and more people, and you need to convince more and more people. Each new person for business, each new client is more expensive for you. Usually, it is kind of a business rule. Of course, there is a rule of platform. For example, if you, I don't know, ss.com, Latvian ad platform. So uh, for them, it is kind of crucial because they can grow when they are big enough, because it is platform and you need to have enough people from two sides, from sides of sellers and from side from buyers. But usually for usual business, when you are bigger, it is harder to grow. Gross margin, yes. As I said, net profit margin shouldn't be always positive, but of course, it's great to be positive, and basically the main sense of business to have the net profit margin positive. But gross margin should be positive almost always. Maybe in the beginning of your business, it could be negative, but basically, if you are growing, if you want to scale your business, it should be positive. And you need to understand that also. On the one hand, when you're growing, your gross revenue margin should also grow, because you can optimize some processes. You can, I don't know, for example, if you have raw materials and you buy more raw materials, then usually you can receive some discounts, etc. On the one hand, it should grow. On the other hand, your sales cost can be increased as well, because as I already told, uh, each new client usually is more expensive than previous one. Yes, average order value. Also, when you want to grow, you need to understand. So, kind of each of business, I believe, has the same target to grow and to increase the revenue, to increase the EBITDA. And increase revenue is kind of a really great target, but how to achieve it? In order to achieve it, you need to increase the number of clients, either, or you can do it together, increase the uh, average uh, average revenue per client. So that's why you need to track both of those metrics. You need to track the number of sales that you made during the month and the average value, average price of each sale. And then you can play with those numbers. What is easier for you? Because for some business, it is easier to double the number of clients. For some business, it is easier to double the price. And maybe you can even lose 10% of client, but still your effect of this decision would be profitable. So twice is great if you can track it. And also there is kind of a rule of thumb that usually your average order value should grow faster than inflation. Then your business can grow. For some spheres, it will not work. For example, for tech sphere, it can for mobile phone sphere, or for I don't know, for car. It could maybe it cannot work because the technology become better and cheaper, and your competitors could make the same product cheaper. But usually, your average order value should grow higher than inflation, should grow faster than inflation. And most recurring revenue, it is also during the last 10 years, I believe it is the most common metric for the venture world, because many of startups, many of venture funds, they make valuation basic basic on one metric, your MRR. When you, I don't know, on each startup conference, you will have MRR, I don't know, 100 times per second, MRR from each corner, because MRR is, and I can understand why, because startups, they don't have positive EBITDA, they have negative EBITDA. So the only thing that they can show off is MRR. And if they have higher MRR, it is great story for them. It doesn't mean that they have negative EBITDA, but MRR is a king for the startup sphere right now. Currently, it slowly is changing. Currently, venture funds and investors they want to see your kind of profitable EBITDA in close future, but still there are a lot of companies who just look at your MRR, at your MRR growth space. They can say, okay, you are negative right now, but you have future MRR. We will think something and we will imagine something how to make the EBITDA, the profit from your monthly recurring revenue. Monthly recurring revenue, basically, it is kind of average revenue per customer times total number of customers. But there it should be kind of important point that this average revenue should be recurring. For example, you have service on subscription, let's say Spotify, 9.979, I don't remember the exact price per month. And there are millions of clients and this is recurring revenue. It works. But for example, if you are e-commerce platform and the revenue is not recurring because on 1 month during the Black Friday on November or during the holiday season, the revenue is huge, but in January, usually the revenue is tiny and you have this fluctuation. And this is not recurring revenue, this is just revenue. And why funds, why in starting from, I believe, 2020s, investors, they like more MRR than just revenue because it is predictable. When you have MRR, your client value is predictable. You can see the client value, you can see the business value. The great story, some years ago, maybe 5 years ago, I helped to the startup who was accepted to the accelerators 500 startup. It is one of the best accelerators in the world. And there was one product, our competitor, who provides some hardware tool to help with headache. Basically, it was small, I don't know, this hardware, you can link it to your neck, and from the mobile phone, you can stop your headache. And they had the price, €200, and it works all life. But the advisors from this accelerator, they told, you can put not €200, but €200 per year. And the number of orders didn't change. So for the end user, it is the same to pay €200 for whole life or to pay €200 per year. But for you as for business, it increased your revenue on for example, if client is at least 3 years of you with this small decision, it costs nothing for you. You increase your valuation 3 times simultaneously. So that's why basically currently we are living in the world of subscription and more services they try to impose a subscription, and investor like subscription and you should like it as well because it is easier for you to predict your future value. And even some chains like some businesses that usually didn't have subscription and it is extremely hard to impose, they started to do it. For example, as I'm not mistaken, Starbucks have implemented subscription for some coffees, some Walmart, they have subscription, and it works great for all stakeholders. Okay, and usually when you have a business, kind of the king is not only cash, but the client, because client brings this cash to you, and there is a special sphere of finance that's called unit economy. It means that we calculate economy not of the business but of the client, of one unit from the business. It is also kind of became popular 5 years ago when more and more startups, they didn't have positive EBITDA, but they had to prove the business has potential, and they started to provide, okay, in general we have negative EBITDA, but let's see, we have a lot of users, a lot of units which could be capitalized. And therefore, there are the whole sphere, I believe there are around 50 metrics about unit economy. You can find the best, the most appropriate for you. I will tell about the main ones. First of all is cost of acquisition. It means each business should understand how costly, how expensive is his clients. How to calculate it? You just need to have all the total marketing cost and sales cost including salaries, including what did you spend on the Facebook target, on the Google target, what bonuses did you spend if you went to conference, all this business trip cost, etc. It is your total marketing and sales cost, and you need to divide by the number of clients. There are a lot of difficulties because, for example, you went to conference on November, but the client came on December. How to track it? But basically, you can do it even in average, and you can see maybe it would be plus minus 10%. Doesn't matter if you don't do it. Start to do it because when you understand the cost of a client, your pricing strategy become better because currently I have faced a lot of situations when companies can make huge discounts because they say, okay, my COGS, my cost of goods sold are close to nothing, so that's why I can make 90% discount and it will be okay. But they didn't count that the cost of acquisition is huge. And basically, when you sold something with 90% discount, you you decrease your EBITDA, so you increase kind of the gap, the negative cash that you will have on the end of the day. So that's why, first of all, you need to understand your cost of acquisition, you need to track it. Even if you cannot track it precisely, it is better than not track it. And also, as practice shows, the kind of the graph of cost acquisition is that it is high at the beginning because you have a team of marketing guys, you have some SMM, target specialists, etc. You invested, you try a lot of hypotheses, so that's why it is really high. Then you have found the best channels that work for you, you scale and it decreases. But at one point, when you have sold your product to kind of the first layer of the market, it becomes to grow again because, as I told, each new client at one point become more expensive for you. So, and you need to understand planning your future cost, planning your future development. You need to understand that the cost of acquisition that was last year most probably would be higher this year, and the same for the market. If you are in Latvian market or in European market, it is great, but it doesn't mean that it will be the same on the US market, or it doesn't mean that it will be the same on the Asian market. It could be either cheaper, for example, in case of Asian market, either more expensive if you're speaking about US market. For example, the potential client, the potential lead for John Galt in Europe and in USA, it is 5 times more expensive, I believe. The customer lifetime value. So the customer lifetime value, it is kind of, I believe, the first most common word in the startup conference is MRR. The second is LTV, lifetime value of the client, because lifetime value is also something that company try to sell you. And there is great case, for example, Tesla. They went IPO also, I believe, 6 years ago. And when they went IPO, they didn't have positive EBITDA, but they had huge valuation because they thought, okay, we have subscription, we will have more expensive subscription. The customer will be long time with us because it is kind of too difficult to change the car, and we will provide great service for our customer. And we have this number of customer, and we will sell to this customer during his lifetime this amount of services. And that's why they would prove their valuation. And as we can see during the tech, as Tesla stock is increasing, so we can see that they have proved that their assumption about the lifetime value were correct. So that's why it is also great metric to make your valuation for your business. For example, if you're speaking with investor, and it is great for you, even if you're not fundraising, to understand the LTV, because at the one point, if you want to exit business, and basically even if you want to receive dividends or something like that, you will receive it by monetizing your customer. So, and there you can when you understand the LTV is important metric, you can put additional KPI for your business to increase this LTV, because there are a lot of possible way how to do it. You can either to increase price, it is the most obvious thing, or you can decrease the churn rate. Churn rate is the percentage of users that you are losing on each month, and you can and if the churn rate is higher, so it means that LTV is lower because it means that the number of users is decreasing. The next important metric is payback period, and payback period, it means how fast you can make the user profitable. For example, when you attract new user, you invest in marketing, you invest to onboard it, and one time the total cost that you spent on user become less than the total revenues you have received. And you also need to understand it, because sometimes the cost of acquisition is huge for some spheres, but you understand, okay, I will receive a lot of money from this user during the lifetime, so that's why I can invest and I can wait until positive profit. As I told, gross margin for business is important. The same gross margin per unit for each client is also important. You need to understand, when you have a lot of clients, you can divide it by groups, and you can see, okay, which of those groups is profitable, which not, and maybe sometimes it is painful decision, but sometimes you need to close some direction because this group of clients is not profitable for you, and yep, it is great when you have a lot of clients, but you need to have not a lot of clients, but a lot of clients who are profitable for you. And average revenue per user, also, basically, I already have mentioned it. It is related to LTV, lifetime value. So you need to understand. So, okay, I have this much revenue, but and this much users, and how can I increase it? Churn rate, I have already told, so that it is the number of users that we are losing each month, and for each business, it is crucial to decrease this churn rate. So we need to think, okay, first of all, we need to understand why we are losing the clients. We need to have the feedback from them. So what's happening, why you stopped use our service, and then we need to understand how we can decrease this ratio. Because if we will decrease our churn rate by 10%, it is equally that we increase our price by 30%. It is rough math, but approximately. So that's why usually it is more important to think how to make our users stand longer with us than just increase the price or increase revenue per one user. Yep, and customer acquisition ratio, it is kind of, again, we need to understand what is proportion of new users over the lost users. So, and usually it should be more than one. It means that your business is growing. Okay, I'll try to be a little faster because I spent too much time on the historical, and let's go to the present. So each business almost has the same timeline and the same speed of development. So first of all, we kind of a seed, we're small, and our main goal is just to have a proof of value, proof of concept. It means that somebody wants to buy our product, somebody is ready to pay for it. Then we need to understand how to scale it. We can scale it if our gross profit is positive. And when we are kind of mature enough, so we can see, okay, we need to strengthen customer relationship, because in this way we will decrease churn rate. We need to expand new markets, because in this way we will optimize our costs. And it is important that here we can either to grow, either to lose our sales, because when we are big enough, it is really hard to grow our churn rate. Even if it is really small, it exists. So we are losing our clients, but it is harder and harder to find new ones. So that's why we need to have some strategic decisions, maybe some, not ordinary decision. We need to think out of the box at this stage, because to save our market share. Yeah, and speaking about the future. So how to build the forecast for a business, how to plan your business. First of all, I already told, as you bigger, as it's harder to grow. So you need to be realistic. If you want to grow faster than previous year, you need to have dramatic change in your business. Otherwise, most probably, if there are some wonders in the market. Maybe the market would be on your side and you can grow because the market is growing. But usually, if you don't make any changes, you will grow slower than previous year. So then you need to have kind of strong budget and to have finance control mechanism. What does it mean, finance control mechanism? You need to understand what is the structure of your costs. The small exercises you can do. Let's count your salaries as a share of revenue, your salaries as share of total cost, your I don't know operational cost as share of revenue, your operational cost as a share of total cost. And when you have this table, you can see, okay, where I can save money, where I need to pay attention, because I have faced a lot of business who try to negotiate with the landlord to have a discount for the rental 10%, but in their cost structure, the rental cost is only 1% from the total cost, but the 99% are marketing costs, for example, travel costs, and they pay attention, they are focusing not on the right thing. So that's why, yeah, finance control mechanism should be in each business, and you can do it like dynamically to see each month how it changes. Analyze your cohorts. I'll try to show you how the cohort analysis work. You on the one side you have a dates, on the other side you have kind of the months number of periods from this date. For example, the cohorts that came us in April 2014, after 17 months, we have only 6.3% from those clients. They are still with us, and you can do it from all clients, and then you can see the most positive cohort. Why it is important? Because first of all, it is easier to plan the future. So you understand, okay, there I have 6.3%. Most probably, if they are already 17 months with us, they will stay for another year. So, and I can see how many users I lose on a monthly basis. Also, I can see better cohorts and I can see worse cohorts. And then I can go to my sales team, to marketing team, and ask them, what did we do in May 2014? Because we have really great cohort. We have really loyal customers. How we can find the same basket of customers? I can have monetized it. And that's why it is kind of it can help you to increase your lifetime value. It can help you to increase your EBITDA and valuation of the company in general. Yes, so basically you can write in chat what metrics do you use for your business, and I will try to give the feedback to it. And maybe if you, for example, want to ask which metrics you should use for your business, just write the sphere of your business, and I will try to make some advices during the Q&A session. Yeah, and the latest part, how to reach the future. So when you have KPIs for a business, when you have the forecast for a business, first of all, you need to understand that it should be realistic. So if you have optimistic forecast for a business, already in January, you will see that it is not reachable, it will demotivate you, demotivate your team, and it will not work. So it should be realistic. Maybe it should be a little bit harder than realistic. So maybe you can challenge yourself, but don't dream. If you, I mean, you will, it is extremely small probabilities that there would be some kind of wonder and you will jump. It would be great if so, but usually will grow with ordinary growth space if you don't change your structure dramatically. So, and when you have your forecast, in order to make it work, you need to do at least the following step. First of all, you need to have KPIs, because usually how the forecast works, you see, okay, my revenue should grow by 30%. And it will not grow if you will do nothing. So that's why the revenue will go by 30% because of the number of new clients will grow by 30%. So that's why we need to go to the marketing and sales team and say, okay, we need to grow our number of sales. So that's why the number of leads should grow by 50%, and the conversion rate should grow by 5%, let's say. Then we need to go to the quality team, or to the, I don't know, product team, I don't know how big business you is, and say, we need to have the retention rate, we need to have more loyal client by 5%. And each department, you need to go to your, I don't know, recruiter, and you can say, we can allow to ourselves to increase the salary amount, the salary volume by 5%, not more. Then you kind of control your OpEx. And those KPIs, understandable, quantifiable, should be for each person. So each number, you need to understand, okay, this revenue consists of those metrics, and each metrics has the person who is responsible for these metrics, because otherwise these metrics couldn't be achieved if nobody is responsible. Then plan fact analysis. The worst case, if you have a plan, for example, for 2025, and you understand what happened only in December of 2025, and you understand, okay, I didn't achieve my plan. It is the worst case. Good case, when you already in January of 2025 understand, okay, I cannot reach my goal, or for example, to reach my goal, I should go even faster, and you can understand, can I do it or not? And again, you should be realistic. And for example, if this goal is crucial for you, and if you not achieve it, you will go bankrupt, then you can, make more out of the box decision, etc. But you should understand it already in November. Don't afraid of the truth, because usually it can help you to grow and to survive. And those metrics should be kind of, you need not only to look at the P&L or cash flow, you need to look on the metrics, and it should be part of your plan fact analysis, of your strategic finance and financial analysis, and you need to track it on a daily basis as well. Not maybe some on daily basis, but on weekly basis, at least on monthly basis. So you need to understand, okay, what is our churn rate? What is our gross margin? What is our LTV, etc. Sometimes it is not important to track all metrics, but usually if more metrics do you have, it is easier to you to make a decision, and it's easier to you to understand, is your aim achievable or not? Yep. But I really hope that all the aims that you will put for yourself, for your business, would be achievable, and I really hope that you can take some useful information from this webinar to increase the probability to reach your targets. And I will be happy to answer any questions. I will open the chat, and we'll see the question. I hope that there are questions. Okay, Angelica asks, which metrics are the most important for marketing agency? Great question. So marketing agency, basically it is kind of, I don't know for sure how marketing agency works, I understand, but it is B2B business. So first of all, you need to understand if it is B2B business, you need to understand the sales metrics. So what is the number of lead, what is the number of qualified lead, what is conversion rate, what is cost of acquisition. Then if your business has a subscription model, usually marketing agencies, they have subscription model, and you can divide it, your revenue on monthly recurring revenue and one-time purchases. If it has subscription model, then you need to track all the unit economy ratios, churn rate, how many customers do you lose each month. You need to track the growth rate of the customers. You need to track RPU, average revenue per customer. You need to track LTV, lifetime value of customer, because based on it, you can make the plans for the future, and you can kind of put targets for yourself to increase those metrics. I'll Sinokraut, I hope that I spell correctly, asks, for your early stage startup, do you have track records to provide financial assessment and valuation? For your early stage startup, the valuation, it is extremely hard to prove it, because therefore usually there is kind of a standard valuation model. If you have revenue, it is great. So there is kind of multipliers of MRR, but usually you're looking on the market. You're looking, you can buy for, I believe, annual subscription costs €300 for Crunchbase, and you can see, for example, post-seed, pre-seed startups, how much money they have raised. You can see in your sphere, and you can target this valuation. And usually when you're going see early startup, it is usually pre-seed round. They are going to angel investor or to early stage VC fund. They have kind of just a rule. They say 20% for €250,000. So, and it means that valuation will be around 1.5 million euros money. So that's why you need to understand for yourself, is it enough or not? You can build the discounted future cash flow. You can try to see, okay, how much you can receive in the future from each client, from a business, but it is extremely hard to prove. So that's why usually for early stage startups, they use market approach methods. What financial due diligence services can you offer? Okay, it would be kind of small advertisement. So basically, we really help to early stage startup to raise funds, and we help to optimize the business model. We help to prove the valuation. Even if this market approach, we can choose the right market, and we can help to prove this valuation to the potential investor. And also in terms of financial due diligence, basically for early stage startup, it is not financial due diligence. It is just stress test of the model the startup has. So how to stress test it? First of all, you're looking at the market, and for example, you can see your role model, and you can see what is the revenue, what is the metrics of the role model, and then you can compare it. So the same, we can see your potential growth space, some cost, because the most common mistakes for startups are the same. The startup believes that they can grow really fastly. I really like when startups will say that my sales strategy is viral marketing, and I will invest almost zero, and it will become viral, and I will have a lot of clients. But I believe there is no person in the world who knows how viral marketing works. I believe it is so random, so that you cannot put all your strategy on this point. So basically, regarding the due diligence of the final startup, there are the two most common problems or mistakes that startups have. They have under budgeting, so they don't think that they need a lot of people, but usually they need a lot of, especially if it is tech startup. And the second is overestimation regarding the growth space. Okay, Natalia asks, if I own clean company, want to revise the pricing strategy, which metrics should I take into account to do this properly? Okay, it depends. First of all, you need to understand the market. So if you have clean company, it's kind of competitive market, and you need to understand what is the pricing of the market. Second, you need to understand your COGS, your cost of goods sold per each clinic, because when you change the pricing, you need to understand your gross margin. And of course, it would be great if you can decrease your price and reach a big part of the market, the largest share. And I mean, to increase your valuation. But in the end of the day, if your gross revenue margin is negative, it is better to have a smaller market share but still be positive as a business. And yeah, first of all, you need to understand market, gross revenue margin, and also you need to see the price elasticity index. For example, if you have already changed the price, you need to analyze how it happened. For example, you changed price by 10%, you have increased price by 10%, but you have lost 5% of client. It is good. It means that in the end of the day, you earn more. But if otherwise you have increased price by 10%, but you lost 30% of clients, maybe you shouldn't be so aggressive. Diana Python asks, beauty industry, small business, what metrics? Thank you. Okay, so again, in beauty industry, it is basically a B2C segment. So, and it is, but it is recurring because when, I don't know, I make any beauty procedure, most probably I will go back to you. So that's why, first of all, I need to understand the number of recurring customer as a proportion, and it should be KPI for you. It should be um, kind of the, a KPI for your sales for each of your team members. That we need to, I don't know, 80% of clients should back to us in 1 year. How to reach it? If you have some personal data of the clients, you need to remind about yourself. You need to understand how fast each client goes to you, and you need to decrease this number. So, for example, if currently the average time between procedures for your clients is 3.5 months, you need to do everything to reach 3 months. So you need to remind about yourself, to provide some discounts, etc., etc. I had a client 1 year ago. I had two clients in the same sphere, from the dental sphere, and one of them they had 80% occupancy, and another client 99% occupancy. The same level of doctors, the same level of services, the same level of prices, and even almost the same location. The only difference, the clients who had 99% occupancy, they had 5% bonus to the reception girl and from the all revenue. And she didn't kind of allow you to went from this dental clinic without the kind of reminders to the next around the booking the next session. So it is important metric for you how fast how big proportion of the client will back to your services. Uh, so Hal Synchros asks, the due diligence here is from an investor perspective, not from a startup. Usually, yes. Basically, in the perfect world, it should be the same because in the end of the day, investor is on the same page with you, and the investor, of course, investor asks a lot of questions, and on the negotiation stage, investor aim is to decrease the valuation, but basically, investor is interested in investing in a kind of scalable business model. So that's why 95% of the due diligence is the same as for investor as for startup because we just understand the health of business model. But the remaining five are different. If investor asks to make the diligence, we want to find the possible drawbacks to um, make the clients to try to have the lower valuation. If otherwise, if the startup asks the diligence, we try to find the possible opportunities to grow to increase the valuation. But 95% of the due diligence of the business model are the same because investor and startup are on the same page. Any other question? Okay. So I'm really happy that so many people stayed until the end. So I will tell a small announcement about our further plans. So we will launch a finance course. Basically, during this course, we will present the same information as today, but more deeply. We will have some real cases. We will help you to build the model. We will show which exact formulas in Excel you need to insert to have formulas. It will be a combination between finance and let's say maybe Excel and I mean basic Excel skills. Because as a main deliverable from this course, it should be that each founder can build the model but himself, that he can understand any model, can read it and see all the plus and drawbacks of his business. Yep, and as I promised, some special bonuses for each of you. First of all of you will receive a financial model template and planning template. And also we provide a 500 euro voucher for all packages. So we are working on subscription base, but also we have one-time fees as well. And so you have 1 week to use this voucher. So I incentivize each of you because January is one of the most important months for each business, because in this month you kind of plan the journey for the whole year. So, and don't lose this opportunity, don't lose this month with us or without us. Please make the plan for your business and try to be realistic, try to be kind of business wise while making this plan. Yep, all the bonuses will be sent to your webinar after, or to your mail after the webinar. Yep. So if you kind of quick enough and you have a faster way of thinking, you can book a free audit for your business. So you can use this QR code and book a free session. Yeah, thank you everyone for joining. I really hope that it was useful, and I will be happy to chat with all of you so you know how to find us. So we will be happy to help to your business grow.